So today, we're taking yet another step to ensure that Canada is the country of choice to make the things that'll drive the new 21st century green economy. We're listening to automakers, we're listening to workers. Shortly, we will be introducing a 100% tariff on Chinese-made electric vehicles and a 25% tariff on Chinese steel and aluminum. See, because of our government's choices and the hard work of hundreds of thousands of Canadian auto workers, we are transforming Canada's automotive sector to be a global leader in building the vehicles of tomorrow. But actors like China have chosen to give themselves an unfair advantage in the global marketplace.
When Canada announced a 100% tariff on American electric vehicles, no one expected the first blow to land directly on Tesla, the symbol of America's technological edge and ambition. But this isn't just another trade dispute. Beneath the surface lies a seismic shift that could reshape the entire global auto industry, threaten hundreds of thousands of jobs, and even shake the balance of economic power between the U.S. and the rest of the world. Is this the beginning of a decline, or merely a temporary setback for an empire? Trade crisis erupts. Tesla faces disaster, but the whole U.S. auto industry may be next. Tesla, a company often seen as the face of American innovation, is now facing an existential threat in one of its key international markets. Canada has announced a staggering 100% import tariff on U.S.-made electric vehicles, a policy move that could reshape not only Tesla's business model, but the entire North American auto industry. If implemented, the price of a Tesla Model 3 in Canada could double from roughly $40,000 to $80,000. This isn't just inflation. It's a forced exit from the Canadian market. Such a drastic price surge would push Tesla out of reach for the average buyer, redirecting consumer attention to European brands like Volkswagen, BMW, and Mercedes, which are exempt from this tariff. But the story goes far deeper than vehicle pricing. Tesla isn't just losing sales, it risks losing investor trust. The company dominates about 70% of the U.S. EV market and had ambitions to expand its Canadian footprint with more than 50,000 units projected to be sold in 2025. Now, that pipeline is under threat. If sales in Canada collapse, Tesla's stock could take a significant hit, creating ripple effects across its global operations. Given that Tesla's market valuation is tightly linked to its growth narrative, a disruption like this could rattle Wall Street and slow down expansion into other regions. What's particularly alarming is that this move from Canada doesn't exist in isolation. It's part of a broader geopolitical realignment where trade policy is no longer just about economics, but power. Canada isn't simply retaliating, it's repositioning. With growing trade ties to the European Union via the CETA agreement and increased energy and mineral exports to Asia, Canada is slowly reducing its dependency on the U.S. In the backdrop, Canada is also securing its dominance in critical supply chains through mineral alliances with the EU, an area where Tesla and other U.S. companies remain vulnerable. This tariff could serve as a litmus test for the fragility of the U.S. supply chain and the consequences of short-sighted trade strategies. If Tesla stumbles here, it opens the door for more global competitors to fill the void not just in Canada, but in other key markets watching this unfold. This moment is more than a trade skirmish, it's a strategic wake-up call. It raises a fundamental question. Can the U.S. maintain its technological edge in a world that's rapidly reorganizing its economic alliances? Tesla may be the canary in the coal mine. If policymakers don't recalibrate soon, this could mark the beginning of a long-term erosion of American influence in the very industries it once pioneered. Beyond Tesla, a trade war that could shake the entire North American auto industry. While Tesla currently finds itself in the crosshairs, it's merely the opening chapter of a much broader crisis threatening to engulf the entire North American auto industry. Canada's 100% tariff on U.S.-made EVs might look like a targeted response, but it signals something deeper, a strategic shift that could unravel decades of tightly woven cross-border manufacturing. At the heart of this storm is the highly integrated auto supply chain between the U.S. and Canada, a network that took shape under NAFTA and was later restructured through USMCA. American automakers like Ford, General Motors, and Stellantis, formerly Chrysler, rely on a seamless flow of components, labor, and raw materials from Canadian plants. Engines may be built in Windsor, Ontario, while transmissions come from Michigan, and final assembly occurs in Tennessee. It's not just cooperation, it's codependence. Now, that entire ecosystem is under threat. If Canada retaliates further with tariffs on EV batteries, steel, aluminum, and especially critical minerals like lithium, nickel, and cobalt, the effects could be seismic. These resources aren't just commodities. They are the lifeblood of the next generation of electric vehicles. The irony is striking. While the U.S. is trying to expand EV adoption through federal subsidies and green infrastructure bills, it's simultaneously pushing away its closest and most reliable supplier. This isn't just about two countries flexing economic muscle, it's about who will lead the next industrial revolution. Europe and Asia are moving fast. China controls over 60% of global lithium processing, and the EU has committed billions to homegrown EV battery plants. If the U.S. fails to preserve its North American manufacturing network, it risks ceding its competitive edge. I see this trade standoff as a test of strategic vision. It raises a question that goes beyond economics. Are political leaders capable of navigating 21st century industrial strategy, or are they stuck in a Cold War-era mentality of zero-sum tariffs? A misstep here won't just hurt Tesla or GM. It could lead to factory closures across the Midwest and Ontario, lost jobs, and a breakdown of the shared prosperity that once defined the U.S.-Canada relationship. This isn't just a dispute over cars, it's about the future of manufacturing in North America. If the U.S. doesn't pivot to a more cooperative, forward-thinking trade strategy, it may find itself increasingly isolated, watching its competitors speed past in the global EV race. Ripple effects, job losses, soaring costs, and fewer cars for American buyers. The ripple effects of this unfolding trade crisis extend far beyond diplomatic headlines or stock market fluctuations. They reach into the heart of the American workforce and household economy. As tariffs tighten the cost structure of car production, automakers will face a brutal financial equation: cut costs or cut people. And history has shown which path they often take. According to the Center for Automotive Research, more than 970,000 Americans are directly employed in the automotive manufacturing sector. Now, experts estimate that tens of thousands of these jobs, particularly in manufacturing-heavy states like Michigan, Ohio, Indiana, and Texas, are at immediate risk. These aren't just numbers, they're families, communities, and entire local economies built around assembly plants, parts suppliers, and logistic hubs. The problem is compounded by already mounting inflation and high interest rates, which have driven the average new car price in the U.S. to over $47,000 as of early 2025. If tariffs raise production costs further, especially on components like steel, aluminum, and EV batteries, consumers could see prices jump another 10–20%. For many Americans, buying a car will shift from being a necessity to a luxury. There's also a dangerous strategic blind spot developing. As U.S.-made vehicles become less price competitive in international markets, automakers will be forced to lean harder on domestic buyers. But the U.S. domestic market is weakening. Consumer confidence has dipped to a 4-year low, and loan delinquency rates are on the rise. Essentially, automakers may soon be building cars for a customer base that can no longer afford them. This isn't just an economic issue. It's a warning signal that policymakers are ignoring the human cost of geopolitical friction. Factories don't shut down in a vacuum. When an auto plant closes, the shockwave hits local diners, schools, housing markets, and small businesses. Towns hollow out. The American dream stalls at the intersection of politics and policy. Moreover, innovation itself could suffer. When revenues shrink, R&D is often the first department to get defunded. That means fewer breakthroughs in electric drivetrains, sustainable materials, and energy efficiency. Ironically, the very areas the U.S. must lead to stay relevant in the global transition to clean mobility. What's happening here is more than a spike in car prices or layoffs. It's the unraveling of a system that has for decades represented American industrial strength. If left unchecked, this trade conflict could do more than damage profits. It could dismantle an ecosystem that once symbolized prosperity, innovation, and middle-class security. American agriculture and tourism. Hit hard by Canada's retaliation. The ripple effects of this unfolding trade crisis extend far beyond diplomatic headlines or stock market fluctuations. They reach into the heart of the American workforce and household economy. As tariffs tighten the cost structure of car production, automakers will face a brutal financial equation: cut costs or cut people. And history has shown which path they often take. According to the Center for Automotive Research, more than 970,000 Americans are directly employed in the automotive manufacturing sector. Now, experts estimate that tens of thousands of these jobs, particularly in manufacturing-heavy states like Michigan, Ohio, Indiana, and Texas, are at immediate risk. These aren't just numbers, they're families, communities, and entire local economies built around assembly plants, part suppliers, and logistic hubs. But beyond the numbers, there's a cultural and emotional toll. Agriculture in America isn't just an industry, it's a heritage. Generations of farmers now face the agonizing decision of whether to sell off their land, equipment, or livestock just to survive another quarter. And it's not just big agribusinesses feeling the pressure, it's local farmers markets, rural co-ops, and supply chains that serve schools, hospitals, and communities. Equally concerning is the impact on the tourism industry, a sector often left out of traditional trade analysis, but one that contributes over $1.9 trillion annually to the U.S. economy. With Canada urging its citizens to avoid travel to the U.S. as a form of economic protest, the effects have been swift and brutal. Canadian tourists, who account for nearly 40% of all international visitors to the U.S., have started canceling trips in droves. In the first quarter of 2025 alone, the U.S. lost over $2.1 billion in tourism revenue. Florida, usually a magnet for Canadian snowbirds, has lost more than $400 million in just 3 months. Hotel chains, beachside restaurants, tour operators, and even theme parks are reporting major downturns. California, New York, and Nevada are also seeing a steep decline in bookings and tourism-dependent jobs. What's deeply troubling is how the impact on agriculture and tourism exposes a dangerous blind spot in U.S. trade strategy. These sectors are not easily insulated from political maneuvering. They are hypersensitive to perception, trust, and stability. Unlike steel or semiconductors, you can't store lost tourists or harvests for future use. This isn't just economic fallout, it's a fracture in the social fabric. If ignored, it could lead to long-term disillusionment in regions already feeling abandoned by Washington. What we're witnessing is not just a trade dispute, but a growing divide between policy rhetoric and the everyday reality for millions of Americans. While the U.S. tightens trade, Canada expands its global reach. As the United States doubles down on its protectionist approach, leveraging tariffs as blunt instruments of policy, Canada is playing a very different game. While Washington builds walls, Ottawa is quietly building bridges, using trade diversification not as a backup plan, but as a forward-looking strategy for long-term global relevance. At the core of this evolution is the Canada-European Union Comprehensive Economic and Trade Agreement, CETA, which has significantly reshaped Canada's trade landscape. Since its provisional application in 2017, CETA has helped push Canada-EU trade above the $100 billion mark annually, opening Canadian businesses to over 500 million European consumers. This is more than a trade deal. It's a statement of intent that Canada is actively reducing its dependence on a single partner, especially one growing increasingly unpredictable. Meanwhile, Canada's energy strategy has undergone a remarkable pivot. Once, nearly 97% of Canadian oil exports flowed to the United States. Today, a growing share is being rerouted to Asia, with countries like Japan and China emerging as eager buyers. This shift is more than symbolic. It reflects how Canada is leveraging its natural resources to court new geopolitical alliances. With global energy demand surging post-COVID and amid supply chain uncertainty due to the Russia-Ukraine war, Canada's hydrocarbons are now a coveted geopolitical asset. But perhaps the most strategic maneuver comes from the minerals under Canada's feet. The Critical Minerals Alliance with the EU has positioned Canada as a key player in the race for control over lithium, nickel, cobalt, and rare earth elements, the very building blocks of the electric vehicle and tech revolutions. While the U.S. continues to rely heavily on imports, many from adversarial nations like China, Canada is brokering long-term agreements with democratic partners, ensuring not just trade, but technological influence. What stands out isn't just Canada's economic agility, but the contrast in mindset. The U.S. approach seems rooted in reaction, tariffs as retaliation, restrictions as leverage. Canada, in contrast, is operating from a proactive framework, investing in multilateralism, sustainability, and strategic redundancy. It's no longer about who's winning a trade war. It's about who's preparing for the next global shift. The irony is that while the U.S. once led the world in globalization and free trade, it now risks being left behind by allies who have adopted its former playbook. In the long run, isolation may win a few symbolic battles, but it rarely wins the future. While the U.S. clings to economic nationalism, Canada is future-proofing its economy. If this trend continues, Washington may soon find that its neighbors and allies are no longer waiting for it to lead. They're moving forward without it. The bigger picture: is U.S. economic power fading? While Canada quietly repositions itself as a modern global trade hub, building mineral alliances, diversifying exports, and deepening relationships with the EU and Asia, the United States appears stuck in a reactive loop, dominated more by theatrics than strategy. The contrast is stark. Canada is executing a long-term economic vision, while the U.S. grapples with short-term political distractions and media spectacle. Former President Donald Trump, who once promised to make America great again through economic revival, is increasingly seen as detached from the very crisis that now threatens the country's economic foundations. As inflation rises, the GDP contracts, most recently by an annualized minus 2.8%, according to revised estimates from the Atlanta Fed, and labor markets cool, Trump appears more interested in quips about Tesla and Dogecoin than in articulating any concrete recovery plan. His administration's response to serious national security concerns, like the unauthorized deportation of a legally protected immigrant or the leak of classified military documents through social platforms, has been defined by a mix of silence, blame-shifting, and vague denials. These aren't isolated PR missteps. They represent a broader vacuum in policy coherence. Spokesperson Caroline Leavitt's press briefings often circle back to nostalgic slogans and selective statistics from Trump's first term, instead of addressing the present crisis with clarity or vision. Even right-leaning networks like Fox News have begun openly questioning the lack of substance. But what makes this moment particularly dangerous is that economic instability is now colliding with institutional drift. The U.S. isn't just struggling with inflation or slowing growth, it's experiencing a credibility crisis. Allies are skeptical, investors are nervous, and citizens are increasingly disillusioned. According to a 2025 Pew Research poll, over 63% of Americans believe the country is headed in the wrong direction economically, up from 47% the year before. What we're witnessing isn't merely political dysfunction, but a slow erosion of America's strategic capacity. The world no longer waits for Washington's lead. Europe is doubling down on green energy independence. BRICS is building its own financial institutions. Even traditional allies like Japan and South Korea are forming direct energy and trade pacts with nations that the U.S. once assumed would remain in its orbit. America's strength was never just its economy, it was the vision behind it, long-term planning, global partnerships, and rule of law leadership. But now, that compass seems to be spinning. If the U.S. doesn't recalibrate, moving from theatrics back to thoughtful policy, it may not just lose influence. It could lose the ability to shape the future entirely. What comes next? A reckoning or a reset? The fallout from the Tesla tariff war is not an isolated incident. It's a flashing red warning light for a much deeper economic and diplomatic breakdown. The United States, once a global champion of open markets and rule-based trade, now seems to be retreating into an outdated model of economic nationalism, and the consequences are becoming painfully clear. Canada's response to U.S. tariffs hasn't just been retaliatory, it's been transformational. Instead of relying solely on countermeasures, Canada is proactively restructuring its global trade relationships, reducing dependency on the U.S. and turning eastward and westward with strategic intent. Through agreements like CETA with the EU, deepened ties with Japan and South Korea, and critical mineral pacts with Europe, Canada is building a resilient web of partnerships that will serve its economy well into the next decade. In doing so, Canada is sending a clear message. Adaptation, not confrontation, is the real path to sovereignty. By contrast, the U.S. continues to embrace punitive tariffs as a first resort, a policy tool better suited for the 20th century than today's hyper-connected, multipolar world. This moment feels like a crossroads. One path leads to continued posturing, fueled by domestic political optics and short-term economic wins. The other demands strategic humility and renewed multilateral engagement, a willingness to listen, adjust, and lead with vision, not bravado. Unfortunately, Washington currently seems more invested in sound bites than substance. The Tesla crisis is symbolic of a larger systemic issue. America is no longer being outpaced because others are stronger, but because it has chosen not to evolve. The global economic landscape is shifting rapidly toward regional trade blocs, digital currencies, green energy supply chains, and resource diplomacy. Standing still, or worse, reverting to old playbooks means falling behind. Recent data supports this shift. While the U.S. focused on tariffs, BRICS nations have expanded intra-bloc trade by 26% in just the past year. The EU has launched its own CHIPS Act to reduce reliance on American and Chinese semiconductors. And China continues to sign dozens of new bilateral trade deals under its Belt and Road Initiative. The world isn't waiting. So, what comes next? A reckoning, where America faces economic contraction, diplomatic estrangement, and waning soft power, or a reset, where it reclaims its role not by force, but through foresight. The choice is still on the table, but time is not on its side. To regain leadership, the U.S. must reimagine its economic policy not as a fortress, but as a platform, one that welcomes competition, builds alliances, and embraces the reality of interdependence in a complex world. Anything less risks not just losing ground, but losing relevance. This trade crisis is more than just a blow to Tesla. It's a warning shot aimed at an outdated economic model. While Canada and other nations are expanding alliances and restructuring for the future, the United States remains caught in short-term reactions and internal political strife. This is no longer about who wins a tariff war, it's about whether America has the courage to adapt to a world changing faster than ever before. History waits for no one. It belongs to those who listen to the times and act before it's too late.